just a quick overview then. SIRS, we're going to do an overview of SIRS. Just last week, a new law went into place, changes to the law, House Bill 913. I've got my 191 page copy right here in front of me, so we'll be sure to get into that, but we'll try to bore you with all that, but it's a lot. It was signed by the governor just 2 weeks ago and effective July 1st. So we're going to highlight some of the impacts of that. And I know there's a lot of questions about that, so please feel free to keep those coming. We talk about reporting requirements, really important now, incorporating your structural integrity reserve study into budgets. I talk about partial funding strategies, restrictions, completion, and if we have time, we'll get into case studies, but I think we're going to be pretty crunched on time here. Just first wanted to just go kind of set the table of, why we have this law. Florida has always been a little bit unique in their laws, but the tragedy, 98 people passing away in the middle of the night, just a little over 4 years ago now, really changed our industry forever and resulted in a number of case studies and a little scrutiny on what happened. And kind of the lawmakers keyed in on three main points I just want to highlight. Florida allowed, which was one of the only states that allowed this, they allowed for a long time the owners to waive the reserve funding with a majority of the majority of the people at a quorum at a meeting. So if you had a 100-unit building and maybe a quorum of 20 or 30, might be say 20 people as a quorum, you could have 11 people vote to waive the reserves if there was 20 in that meeting for the whole 100-unit building, and the 98 or 89 other people there might not know what's going on. So they felt that threshold to waive was too easy and a bar that enticed too many associations to take that. You saw that a lot, Jason, right, with your communities?
We saw a ton of it. Most communities were in the I'd rather be asked later than save conversation. And Matt, I do a lot of national stuff. I go to conferences, I talk to our colleagues from across the country, and we always kind of got like sneered at, laughed at. Reserve studies have been done in the rest of the country for the last 25 years. And the fact that most of us didn't do them, or the few that did waived almost every time, the rest of the country never understood. So we're as far ahead of the country as we are in a lot of things with the association laws and practices. This was one where we were lagging, and it definitely made that impact of Surfside, which I get to drive by a couple times a week, made a huge change. But I think it was necessary. Sometimes you need that shot to make things happen, and this was one of those. It was a horrible tragedy, obviously, but the change is a good one for our industry in general.
Yeah, and I think a lot of boards, no one, and I'm on my board at my condo association, and I hate telling my neighbors when our fees have to go up. It's not fun. I'm not the most popular guy during that time, but it is kind of a boost. I think a lot of boards are looking at it as a boost to say, look, we know this needs to be done, and so we kind of have to. Our arms are tied. It's encouragement to do it. So, but anyway, that was like one of the first things that they keyed on, saying, how can we have this such a low threshold to waive the reserves? How can it be so much easier? You're right, compared to the rest of the states in our union, we just don't have that. They also found that a lot of boards that did have reserves, and Champlain Towers South Board was one of them, spent money on curb appeal items, spent money on a nice lobby, and they spent money on pool furniture and things that, of course, impact the value of the units, but they felt that the cosmetic items and spending money on the cosmetic items was done at the detriment of the structural components. We still don't know why the building collapsed. We're not certainly going to opine on that here today, but you have to wonder if they had spent less on the cosmetic items and more on structural components and concrete restoration and things that they knew they had issues on ever since they got their report in 2018. Like, could we have seen a different outcome there? And that's what the lawmakers, especially the House, was adamant that no more spending safety reserves for safety items on cosmetic components. So they wanted to create this separation of reserves, which we don't really see in other states. But I know, like Danny Perez, who's the Speaker of the House, was adamant about doing that. And I think that there's pros and cons to that. Unfortunately, there is that pressure that boards, we're all people, right? And we succumb to what might be more visible and more popular with the membership versus something that's back of the house that nobody ever sees that plumbing, nobody ever knows about it until it's an issue. So it's hard to justify big dollars to go to those items, but critically important to maintain our infrastructure. I think our whole society has that issue sometimes too. When you look at our departments of transportation and other things, it's sometimes about maintaining the things that aren't that sexy, right?
Very true.
And then no independent inspections. That's one that I think a lot of societies over the years, and my next slide is kind of showing, a lot of states are looking at creating some kind of guidelines about reserve studies or reserve inspection, reserve funding, because as our buildings age, there is no national requirement or statewide requirements really in many states to do re-inspections of our buildings to ensure that our owners are doing the things that take care of properties, because there are a few universal truths in this world, and one is that as infrastructure, as property ages, it requires maintenance. Maintenance requires money. Maintenance isn't free, and without money, maintenance often gets deferred, and then it gets more expensive. So it's like these are kind of just father time, mother nature. Like we can't eliminate those. And our laws in a lot of the states. This map is just showing some of the states. You see a few there: New Jersey, Maryland, Tennessee, and Florida have all enacted new statutes since in the last few years. New York, Illinois, Michigan are all considering. North Carolina's considering some additional changes right now as we speak. So it's definitely a trend nationwide to think about what happens to our community association. How are we going to stay viable as we age? And there's no shortage of people moving to Florida still, and I don't think there will be. And condos are so important. Jason and I both have had conversations about, yes, we hear a lot about retirees and condos are needed for older folks, but that was my first home, and I think for a lot of people, younger folks and families getting started, there's just no way to buy single family homes in a lot of communities, and condos or HOAs are that first step to home ownership. It is the affordable housing, and unfortunately, and sometimes the only option in some communities for younger people too.
I'd say the majority of the communities that we manage, that's the case. It's more the that level, or the people who just don't want the responsibilities of home ownership or single family home ownership that choose that lifestyle. So it is a desired lifestyle in Florida and other places, and it will continue to grow. I don't think this is going to curb that in any meaningful way.
Right. I think some stats I read said almost half of our population lives in a condo or HOA in Florida, which is meaningful. I think you're right. It's going to continue. So now we have something called the Structural Integrity Reserve Study. We're going to run through kind of what that is, setting the tone for it. Sorry, setting the tone for the changes that have occurred. And one of the changes right on this first slide. So what doesn't the SIRS apply to? So it doesn't apply. It's required for all residential condominium properties that are 3 stories or higher. And this year, 2025, now the law added the word habitable or habitable. I'm not quite sure how to pronounce that. Yeah, tomato, I guess. So that's kind of removing the requirement that existed in the prior couple of years for a building that, say, had parking on the first floor and 2 residential floors above that. So that would only be 2 habitable floors. Habitable is defined as places for eating, cooking, sleeping, or living. So if it's just a garage, just a bathroom, just a laundry room or storage rooms on that first floor, or any one of the floors, I guess that might not be considered a habitable story. And then the statute always excluded single family, 2-family, or 3-family dwellings. They added this year 4-family dwellings with 3 or fewer habitable stories above ground. So carving out some of the smaller buildings, they felt that maybe some of those buildings were not needing to have the structural integrity reserve study. It also doesn't apply. Go ahead. Sorry, Jason.
No, go.
It doesn't apply to non-condominium form of ownership. So if you have the mixed use buildings, I know you have a lot of those down there in Miami, it only applies to the condominium portion and only to the portions maintained by the association. So if the owners maintain the windows and doors, which we'll see on the list, those are not part of the structural integrity reserves.
Yeah. And I think when you say mixed use, Matt, we're referring to like those buildings that are part apartment or part hotel or something like that. Because there are still some residential condominiums that do have commercial spaces on the first floor, and I think those still fall under this.
Good point. Good point. Yeah, not just a few units, but have an entire section of the building or something that is not residential condominium. The structural integrity must include is a study of the following items: the roof, the structure, the fireproofing, fire protection systems, plumbing, electrical, waterproofing, painting, windows, exterior doors, and any other item that has deferred maintenance expense or replacement costs that exceeds $25,000. Not right now. The statute up to this point had said $10,000, and that was actually for all types of condos, whether they were SIRS or not. There was a requirement in there to do structural or to do reserves for items over $10,000. But that $10,000 is a number that was put into the statute in 1984. So this is a bit of a modernization of that number, bringing it up to today's dollars.
Yeah, that was definitely a good change. It's inflation has happened.
Yeah, I will say, there's small, like where I live, it's a small community, and $24,000 expense is going to be quite a hit to our operating budget. So we're going to still reserve for a lower amount, and you can. A lot of communities would say, I'm going to reserve for anything over 5,000 or 3,000 or 10,000. You can keep that threshold if you want. This is just the maximum level that it could be, the threshold at. So big communities that have $1 million budgets maybe can absorb the $24,000 pump or repair to something that would impact one of these other items, but they can fund it through their operating maintenance as opposed to reserves.
Yeah, I mean, this is a common struggle that the state has when developing these laws, because they blanket everything from a 10-unit building to 1,000-unit building. So they have to have that thinking when they put it out there. But to your point, you need that educated decision, right? You take the full reserve study, and which you include things that are beyond the 25,000, and then you can make an educated decision as a board as to what makes sense for you guys for those non-service items.
Yep. And what's not on this list? Lila Mateo, one of our guests here, asked the question: should an elevator replacement be included on here, Jason?
That's literally what we were talking about earlier. I wish elevator was on there, Lila. It's my sort of pet peeve because I know what an elevator replacement costs. I've done dozens and dozens of them. But we have to interpret what was happening, right? And my feeling is that the state felt if the elevator doesn't work, the building's it's not a structural defect, right? It's inconvenient as can be. Walking up 30 flights of stairs is no fun. But it's not in their opinion, what they would have called a life safety issue that's going to cost someone's life. So I don't agree with it. All of my communities were pushing them hard to make sure they're reserving for it outside of the SIRS reserves, because you should still be considering that. But it's definitely one of a few items that is not in this list that is still something you need to absolutely consider when you're doing your reserves.
Yeah, great point. And there's actually a lot of components I think that are key to the building's health and safety that don't necessarily fall into this list. Your air conditioning equipment is going to be very important if you live in Florida here and you don't have air conditioning, and that's common. Boy, I'd sure want to have that. And then things that maybe aren't life safety issues, like you said, Jason, but swimming pools that aren't attached to the structure, your parking areas, and even that lobby renovation that we talked about. I mean, it's a cosmetic item, and it's not going to be critical to the safety of the building, but it absolutely is an important part of your community, the value of your units, and how you market your association and how you stay competitive. So yeah, there's still a requirement. So essentially now we've got the structural reserves. There's still a requirement to reserve for those other items. Those other items can be waived by a majority of the votes, majority of the voting interest, but nonetheless, they're kind of a separate schedule. We kind of have two pools of reserves. We'll talk a little bit about pooling in a little bit. Moving on then, so the structural integrity reserve study must include the life of the item, the cost, and the maintenance expense of the item. We can exclude items with a useful life of over 25 years. The initial version of this said like the floors and the foundations had to be included in there. They limited this to anything with a remaining useful life of 25 years. So anything that's likely to be replaced in the next 25 years has to be included. And it clarified that the statute or that the SIRS can include maintenance items, not just doesn't have to be replacement. And concrete restoration is probably the best example here. You're not going to replace the entire structure of the building, or hopefully not have to replace entire balconies, but you will likely require some maintenance expenses, some concrete restoration, some repairs as that concrete ages and the steel inside rusts and expands, et cetera, et cetera. So who must do it? There's 4 qualifications of folks that are eligible to do the structural integrity reserve study. The previous version, there was a slight change in this because we saw some, I'll call them maybe some bad actors or some folks that had conflicts of interest put in when they were doing this. So there's a requirement now that these professionals must disclose their intent to bid on any related services. So if they're planning on, if they want to manage that concrete restoration project, that's got to be disclosed up front when they propose your structural integrity reserve study. And they also made sure that these are the people doing the reserve study. There was a statute initially that said anyone who's qualified can do it, but the inspection had to be done by one of these 4 individuals. Now it simply says the report has to be done by one of these 4 individuals because we saw some engineers, I think it was, that were doing inspections and then saying, okay, the CPA can figure out how much everything costs and when it needs to be replaced, but here's an inspection report with some pictures, and that was it. And there was a bit of a shortfall or maybe a loophole in the current statute. So now your report has to be done and stamped by one of these 4 individuals. And they gave us another year. So the initial deadline was December 31st of 2024. They moved that to December 31st of 2025. I don't know how much that helps. We still don't quite know how many folks are out there that haven't done it. It's safe to say there's a fair number that did not meet the December 31st, 2024 deadline. And so if you're one of those or know someone that is, the deadline's moved, so they get a little bit of a grace period here. But I'll tell you right now, we're scheduling, and most of our competitors are scheduling out into the fall already for inspection. So that date's going to be here before we know it. So if you haven't done it and you need to get it done, now would be the time to act on that. It's required every 10 years, but it can be delayed for two reasons. And one's been in the statute for a couple of years, that if the milestone inspection is due, so say you're going to turn 30 years old, that's when the milestone inspection is due before December 31st of 2026, you can defer the SIRS to coordinate with that. So if your milestone comes due next year, you can still defer your SIRS to coordinate with the milestone in 2026. And it also, this year they added a number of provisions to really ease the burden on folks that are focused and allow communities to focus on their milestone work before they worry about their SIRS. And then this one, it says that you can delay you can delay your SIRS for up to 2 consecutive budget years immediately following the milestone inspection. So you don't have to do both at the same time, which probably would have been nice if they would have put that in initially. But here we are now. So now they've got that kind of bridge to say, let's focus on the milestone issues. And high level, Jason, you want to kind of just describe the difference between the milestone and the SIRS?
Sure. So I know we have a lot of South Florida people on since we're involved. So Southeast Florida has had what we always call the 40-year recertifications in Dade and Broward. So for those of you who've heard that recertification term, that's very similar. That's where the idea of a milestone came from. On a broader sense, the difference is pretty simple. The milestone is an engineering report that says the building is safe to occupy, or there are these deficiencies that we're concerned about that should be corrected immediately, right? So these are immediate repairs that need to be done to make sure the building is safe to occupy for the next 10 years. The reserve study, or the SIRS, is more of a planning tool for long-term, right? You're trying to plan when is the elevator going to need to be touched? When is the AC going to need to be touched? Those things for a long-term plan out there. So you have the 2 different reports, and they're not the same. They are definitely hand in hand, and they help each other. But they are very different and get utilized in different ways. I want to back up 2 seconds to 2 things you were talking about, Matt. You talked about who and when, right? And I think those are critical. You're not going to say it, but I am. the who is critical, right? Like there's a list of people that are on here that Matt says that the law says we can use. But you want to make sure you're vetting those people. Just because they are eligible to do things like in many professions doesn't mean they have the skills and the expertise to do so. Make sure you're talking to them, figuring out how many they've done, when they started doing these. You know, there are a lot of young companies that said, this is a great industry, I'm going to get into it. Good for them. I appreciate them, but you just need to take it with a grain of salt and understand they're new to the industry. There are plenty of people who've been doing this, like we started this at 20, 25 years. This has been around. So make sure you're taking on somebody who makes sense. And the when is my other part of the conversation that I think is a bigger conversation, but we'll just touch on it for 2 seconds. The law says 10 years. Matt will tell you when you listen to one of his other classes, you really want to do this every 2 or 3 years because those numbers change dramatically. And it's not a full study, it's a shorter version. But it's something that you need to keep up with. Like any other preventative thing you would do for yourself or your community, if you're not keeping it current, it's not as valuable as it could be.
Yeah, and we've seen just a huge number of, and on the West Coast where we had the hurricanes last year, we're seeing a huge number of updates, after 1 or 2, even 1 year, because that storm changed everything for a lot of buildings. New roofs, changing the timing of their painting projects, new electrical systems, all of that may be getting done now. And so to their benefit, unfortunately, it's not fun to go through, but when they come out on the other side, their reserve requirements are going to be adjusted because of that in a positive way. So we're seeing a lot of folks updating it pretty regularly. And yeah, it's a great point because I fear the community that's going to use a 2025 structural integrity reserve study set their 2034 budget. I can only imagine how far off those numbers are going to be. As good as we like to, as much as we like to think that we're great estimators, no one's that good, unfortunately. So thanks for that, Jason. Yeah.
Yeah, I kind of think of it as a living document. It's definitely needs to be looked at and touched and things like that.
Absolutely. Great point. Once you get the SIRS, there's a few reporting requirements. Most of this was put in last year under House Bill 1021, but this is updated now for 913. So once you get the SIRS, you have 45 days to distribute a copy to each owner. You can distribute it electronically, that's fine. And you must provide the division a notification, a statement indicating that the study was done and completed to each owner. There is a website now, which I will pull up and share in the chat for people to look at, where you could actually go in and look to see if your building has done this. And anybody can go in and look and see that. So banks, insurance companies that might be looking at writing policy, they can go and see if this was submitted or not. This year, 913 added a statement that as an officer or director must also sign an affidavit acknowledging receipt of a completed SIRS. So the lawmakers are concerned that people are not doing these, and they want to make sure they get a handle on who's doing them and who's not. The division is kind of required to report on this every year, and you must hold on to your SIRS for 15 years after it's completed. There's a lot of questions, from the very beginning. Well, what's the state going to do? How are they going to know? What are the consequences going to be if we don't do that? And I think probably the biggest concern that I have isn't probably from the state, but from mortgage companies and banks. The industry will probably act faster than the division will. The division's added a lot of people. They're going to be investigating. Certainly, they have the ability to find associations that haven't done this, but the inability, I think it would be tough for a building that hasn't done their required structural integrity reserve study or their milestone for that matter to get a mortgage, because banks again are going to be looking into this. The prospective buyers are required to get a copy furnished to them. And so buyers are asking those questions as well. And so if you don't have the right disclosures, or if you haven't done the SIRS, I think that's going to be a red flag for building. And Jason, you deal with realty all the time. You can speak on that further.
Yeah, it's absolutely happening already. It is not a question of it happening. It is happening. The other repercussion we're seeing is communities that are trying to get loans for the community. A lot of the banks are saying they don't want it without the SIRS or the milestone. And the SIRS makes a lot of sense to me. When they're loaning on a project, they want to know what project's going to come next year, in 3 years, in 5 years. If they're giving you a 5 or a 7 or a 10-year loan, they want to make sure you're going to have the funds to hit everything that's in that time frame. But on the individual mortgages, we are seeing it on a daily basis now. It's a question that comes up. There are lenders that don't want to touch it without it. And I think Freddie Mac and Fannie Mae are going to push that even harder.
Well, it's just not something you can avoid. And I'm gonna just put on in the chat. There's a general website that the state put together with a lot of frequently asked questions and stuff about SIRS and milestones. And then my second link here is the actual database. You can go right in and search to see if your building has complied or put that in there or not. People are asking us, does Reserve Advisors report to the state who we've done the studies for? And that no, the requirement is that the board or the manager, I guess, or their board or their agent discloses that yes, this was done and distributed to the membership. Because we, as reserve providers, we don't necessarily see what's been distributed or not. We give it to you, and then does it go from there to the rest of the membership or not? That's where the state wants to make sure everybody's seeing it. A couple of now incorporating to the budgets. So we had a deadline, and that actually is still in there after December 31st, 2024. The reserve amounts must be based on the findings and recommendations of the most recent structural integrity reserve studies. So that's for your structural items. For the non-structural reserves, you don't have to do a reserve study for those. It is a best practice, but you can still come up with your own estimates for those items. The House Bill 913 introduced an ability to pause and ability to use alternate funding. So I think there was a question in the Q&A about, can the budget be paused for 2 consecutive years, or can you delay a budget for 2 years as well? So the paraphrasing is here again from the 191-page bill, but for budgets adopted or in the next 3 years, essentially 4 years, I guess maybe you could say, before December 31st of 2028, the reserve funds can be paused or reduced for the purposes of funding repairs recommended by the milestone inspections. So if you haven't had a milestone inspection, I don't think you can pause. If you don't have repairs from your milestone inspection, I don't think you can pause. But if you're working on significant milestone inspection repairs, there's a case there that you can pause the reserves for up to 2 consecutive budget years. The general, oh shoot, I guess my rest of my slide there is a little bit is just a replay there, but the pause. I'm sorry. The other thing I wanted to mention here is that you can also use. They included that you can use special assessments, loans, or lines of credit to assist with funding reserve contributions as well. That those alternative funding methods, as well as the pausing, does require a majority of the voting interest to agree to do that, and then variances from that, or once the pause is complete, an updated SIRS structural integrity reserve study is needed. So it's still, if you follow everything, it's still only 10 years, but once you start to veer off or use alternate funding, then that's the update is required prior to the next budget year that you have to get back on track. So a majority vote, and it's a majority of the voting interest required to waive or partially fund your non-structural reserves or your structural reserves if you have one of those cases where you're working on milestone work or approval to use a loan or a line of credit or a special assessment. And we've got a couple case studies, but maybe we want to talk about that now, Jason, a little bit about, is that a real viable option? The special assessments and loans, have always been things that associations have used when they have immediate projects. So I think there's cases for that, but do you see a lot of associations going this line of credit route? Have you been talking with banks about that at all?
So we've talked to a couple of banks and banking partners that we work with, and they're not finding a way to do this loan or loan for reserves doesn't really make sense to most banks at this point. It was a relief mechanism that the legislators were trying to come up with, but it hadn't been flushed out by the banking side yet. So I haven't seen one that exists. I know there's a couple bankers trying to put them together. You and I were talking about it. It's very much like, borrowing on your credit card to put money in savings. There's definitely an illogical thought there to me. But we haven't seen one that works yet. Loans are great for immediate repairs and things you need to do if you don't have money in reserves, right? That was how they've been used for many, many years. But I think this just doesn't give you a mechanism that was intended for at this point. If and when some banker comes up with a brilliant idea, I think we'll all share it very quickly. But we haven't seen it yet, I guess is the short answer.
Well, and I think I actually think the intent, because we talked with the staff and the lawmakers about this, the intent is not to do this as a long-term solution. You mentioned like borrowing to save. Yeah, you're not going to borrow to save for your retirement, but you might borrow for that car payment that you're going to make immediately.
Yeah.
So if you have something right away, and again, it goes back to those buildings. And look, they heard from a lot of buildings. There was a lot of stories in the Miami Herald and other news outlets talking about buildings that had done nothing for 40 years, had not reserved, and now they were having big special assessments, and because of the milestone work. And in addition to doing the special assessment for the work that hadn't been done, they're on top of that having to save for the next item that needs to be done, or the roof that maybe has a few years left on it, but it is also underfunded. And so they kind of compounded. They felt that they were compounding these issues. So they wanted to make these options for buildings that had a lot going on right in the near term to provide a little bit of a breathing room or a little bit of a path to get on track. And I think that that's the only cases I've seen where these loans or even lines of credit probably work well, is if you've got in the next, say, 2 to 3 years maximum, that you've got a big outlay of cash that you don't have savings for, consider financing those pieces or special assessing those pieces. But recognizing that, yeah, that means there's going to be some loan payments that are going to be coming after that. In fact, some repayment over that term, and also the reserve funding is going to have to increase after a couple of years as well. So it's really, I think there are cases where it makes sense, but those cases are only ones. It would not make sense for a building that has significant useful life, or even 4 or 5 years of life left on a project. If you have 4 or 5 years before you want to buy a car, the best thing to do would be to start saving now for that and not wait and then take out a loan for that. And I think that's, when we talk about personal finance is one thing, you can make those decisions, but when you're talking about a community association and the viability and again, the perception in the marketplace, the mortgage companies, if you're continuing to borrow, it's not going to be looked on that well as a community that Fannie Mae and Freddie Mac want to back your mortgages in. And they have a blacklist now. I think it's over 5,000 communities, last I heard, of communities that they won't approve loans to. And you get on that list, and that can be a big problem.
Yeah.
So let me keep going here. A couple more slides, and we'll get to some more questions. Reserves are restricted. There was a question in here. I think I answered it. Yeah, about how do we fund our elevator or AC? You can fund it with your elevator and your AC reserve. You should still have reserves for your non-structural items, and that's where that should be. But reserves and any interest accruing thereon shall remain in the reserve accounts and only used for their authorized purpose unless their use for another purpose is approved in advance by a majority of all the voting interests. And then owners cannot waive reserve funds after December 31st, except in those conditions that we talked about prior. We got some stuff on funding strategies, because this is still a main question that I get. It's like, what do we have to have? Do you have to have fully funded reserves? I was working with the association this week that their structural integrity reserve study said their fully funded balance, which was the total amount of wear and tear in the whole building for the last 40 years, was like $2 million. And so that was it. And I think they had 200,000 in the bank. They said, well, the structural integrity reserve study said, well, you need to contribute 1.8 million to make up for all the wear and tear over the last 40 years. And it just, to me, that's it's achieving 100% of the fully funded balance. That's the full funding on the right-hand side of your screen here. That's what we talk about there. That's how to calculate it. But there is nowhere in the state statutes or administrative code or anywhere in the state of Florida that says we have to have a fully funded balance. We have to be fully funding our budget, but we don't have to have a fully funded balance. So I use the example of a roof, that's for real simple purposes, 10 years old, $100,000. The fully funded balance in year 7 is going to be $70,000 for that. And so if you said we had to have a fully funded balance, we'd need $70,000 for our roof. you take that and you add up each component in the building and you get this big number. That's your fully funded balance. And you say, well, I've got half of that, so I'm 50% funded, or I've got three-quarters of that, so I'm 75% funded. Um, the only requirement in the administrative code is really what is to keep the reserves from falling below zero, to keep the reserves from going negative, which is actually how we would define baseline funding in our industry. So there's just a lot of confusion around that topic. So that same roof, let's say the previous 7 years, you're in year 7, and the previous 7 budgets have waived all the reserve funding for that. So we've got nothing in the reserves. As long as we're putting in our budget $33,333 for the next 3 years, we have a fully funded budget and we'll have enough money to replace the roof when it's needed. It can't be 25,000, 25,000, 50,000. That the association would consider that, or the division would consider that a balloon payment. So it has to be stable funding between now and the time the unit's needed, but just to keep the reserve above zero. So a lot of communities, and in fact, that was language added into the statute to clarify this. I think it was always the case, but they codified it. That's a, the structural integrity reserve study must include at least baseline funding as the minimum level. Most of our communities try to find probably somewhere in the middle. Threshold funding is usually our recommendation, because taking your reserve all the way down to zero is probably not a great plan, and you want to have a little bit of a cushion there. So we put a threshold that keeps the reserves above zero. It's kind of the minimal risk level. It's not as expensive to fund as full funding, but not as risky as baseline funding. So I kind of call it the Goldilocks approach. I don't know, Jason, do you have anything on that?
I agree with you. I think the state created some of this confusion in creating a new term that didn't exist, and trying to say baseline funding, but using a different term for it. I agree with you. We try and keep our communities a little higher than baseline into that threshold funding, because as we said earlier, this is an estimating tool. It's not perfect, right? If we hit a crazy inflation, or we hit a tariff issue or a supply chain issue again, those numbers can tweak easily and quickly. We saw roofing costs go up a few years ago. They're back to where they should be. But if you want to make sure you have that cushion, so that when things happen, you're not draining yourselves to zero, or, the super unintended of getting to not having enough money in there and now having to special assess. The whole point of this was to fund it so that your owners aren't hit with a special assessment when that time comes. So it's more of I say it's an art, not a science. There's some science in the background and a little bit of skill that goes on top of that, that you have to do.
Yep. Yeah, I'll walk through a quick example of this too, because you're absolutely right, Jason. And it's each community is a little different. You work with your manager, you work with your reserve provider to determine what's right for you, kind of what the appropriate risk level is. I have a lot of communities that have big insurance deductibles or lots of uninsured items, and they say, those communities tend to want to leave a little higher threshold too, because of that exposure potentially. And then we have communities that are just trying to get by, they're trying to get on track, they're trying to get by, and they've got some real near-term expenses. But here's kind of a typical example, just to run through some numbers for people. This is an example of a community that had over the next 30 years about 1.5 million to spend. The baseline funding, the minimum amount, which you can see in this case, the blue bars are the expenses over the next 30 years. The green bars are stable contributions going in, and you can see based on those expenses and the stable contributions, the balance is going to jump around a bit, and it kind of goes up and down, but it goes all the way to zero towards the end of the study. It goes all the way to zero. So this is baseline funding. It doesn't go negative. This would be appropriate for considered, a budget that would not need to be waived. You would not have to have an owner waive the reserves as long as you're contributing. In this case, it was $49,000 a year, $132 per owner. Because a lot of the expenses are out there pretty far, it was like $9 more to build a nice big threshold in this reserve. So now this reserve, instead of going down to zero, never drops below 100K after the first couple of years. And so that was a decision. And then again, most boards see these numbers like, well, for $9 more, in this case, a year, it's just a smaller community, but $9 more a year for reserves, like let's build ourselves a little bit of a cushion there. The funding went up slightly, but you can see $3,000 in this case was like a 6% increase or something like that. Full funding, we identify through this like straight line depreciation schedule. But for the same community, then to go to full funding was over $213 per year. So this was now almost doubling the requirement to go from 0% funded all the way up to 100% funded. And you can see the orange line there is their percent funded. Again, that kind of drops off, but the balance here you see kind of just goes up into $1 million and never looks back. Just keeps going up and up and up. And that's where a lot of communities say, that full funding, and I would say vast majority of our communities are not anywhere near 100% funding, nor do they need to be, because they're not spending all of that money in any one year. But we do see, like I said, studies, this gets them to 100% funding over 30 years. I've even seen some that said, well, in the next 2 years, you have to be 100% funded, which means this giant spike in funding and probably overly conservative. Nancy asked if there's a technique referred to as cash flow funding. This is all of these examples are cash flow funding. So I know it's confusing, but there's two methodologies that are used. One is component method, and one is the cash flow method. The cash flow method in Florida is always called pooled reserves. The administrative code put that in there, so that's what kind of latched on. But it's cash flow funding and looking at the flow of cash over a period of time. That slide I had previously, if I can get back to it quick here, this previous slide, that's kind of more of a component type analysis where we're figuring out the fully funded balance for each individual component. And most communities are using pooled reserves. I think I have a slide on that here as well coming up. Pooled reserves are allowed. 913 went on to expand and says, very, very clearly that they maintain that the reserve accounts may be pooled for two or more required components. But the paragraph G items, the SIRS items, may only be pooled with components in paragraph G. And so the other cash flow would be for your non-pool. So we need two pools essentially. And they want to say the vote of the members is not required for the board to change the accounting method for reserves to pooling or straight line method. So those are the two methods. Again, pooling is synonymous with the cash flow method. Straight line is sometimes called the component method or restricted method. I've seen a few other terms on that. Most associations are switching to pooled reserves. In my experience, there's more flexibility, lower funding required than keeping many buckets there. But there's still that flexibility. As some people look at that as a drawback, that the board's going to make poor decisions with the money. I think that's mitigated by these requirements. It says, look, you can only spend your structural money on structural items. You can't go put it on a new sign or a new hot tub when we need it for something else. So I think, and again, most boards that I talk with by far are trying to do the best that they can and trying to make good decisions with the best interest of the community in mind. So I think that's a little bit mitigated. It is less conservative to do that cash flow method, especially if you're looking at baseline funding. It's a little less in the bank at any one time.
Yeah, I agree. The two pools are a great improvement. It's more accounting work. It's not that much more, but it definitely gives you the control that you're looking for to make sure your structural items are reserved for separately, and still gives you a little bit of flow with the timelines and when you need that money. So
yeah,
we've been recommending pooling for years. It's just a great method.
Yeah, ever since 2002. It's interesting. Florida is the only state that ever used the other method because it was required until 2002 for condos in Florida when the Florida Administrative Code changed. So a lot of the communities that were built in the 70s, 80s, they had to do component reserves by statute for many, many years, and so many have just kind of continued on with that. But it's been over 20 years now that pooling's been allowed, and we've seen first 10 years, everyone was scared of it. Now, ever since then, we've seen a pretty good migration of people over to pooled reserves. And this might be a good time to answer Spence's question here in the Q&A that given the date changes in House Bill 913, when must a budget first include separate contributions for SIRS and non-SIRS based on the pooled report? So we'll answer that part first. And I think that's still the same. That says any budget adopted after December 31st of 2024. So now that we're after that date, any budget adopted going forward will have to have that segregation. And it says, and by when must the pool of total reserves be divided into separate SIRS and non-SIRS pools? My advice would be again to do that at any time, any budget that you're passing after December 31st, 2024. That's going to have to that split should have already happened there. So now I guess would be
Yeah.
my way to phrase that. Do you feel differently, Jason?
No, I'm with you. I was literally having that conversation last week with a client, looking at their reserves and figuring out what makes the most sense and how we sort of aggregate those funds, right? We've got all this money, and as we were talking about, there are two different pools. There's things that are happening immediately, things that are not happening immediately, and how do we split them intelligently? And it really does take some analysis and some thinking of what you're going to do, and then showing how it's going to affect the assessments. But it takes some time. So to your point, Spence, start thinking about it now and do it as soon as you can, because you want to make sure you get it done right. And once you move that stuff into the SIRS reserve, it's there. It's not going anywhere. So you just make sure you're planning properly.
Yeah, and remember the disclosures, those resale disclosures all affect on any contract signed after December 31st, 2024. So again, the sooner the better to get that all done. We get the question, what's considered completion of the SIRS, because, and I think that I've heard a lot that say, well, we didn't agree. We got the SIRS, but we didn't agree with it. So we didn't share it with the membership, or we don't, we haven't getting a second opinion. You absolutely can get a second opinion. But I don't think because the board doesn't sign off on the SIRS doesn't mean it's not a completed report. I'd encourage you, if you don't agree with the findings, if you don't agree with some of the timing costs, look, we make mistakes. Everyone in our industry is we're making estimates, and there's usually a few different factors that can impact that. So if you don't agree with it, go back to the provider, ask them to change it. If they refuse to change it to your liking, you can always get a second opinion. But it doesn't, you cannot, like in the past, you could get the reserve study and then you go bury it, out behind the clubhouse and no one ever look at it again. And I don't think we can do that now, given the required disclosures that we talked about.
And nor should we. And the good news is our owners are more savvy these days. So, share the information, that's their own, it's their investment as well. They should have this data.
Yep. So I know we got only about 10 minutes left here. Oh, hey, Matt. I didn't see you.
Hey, Matt. Hey, Jason. How are you?
Hello.
Matt's from our team in Milwaukee. Been listening in here, and appreciate you joining us too. There's a few questions in there. I think it'd be good to do some rapid fire.
Yeah.
We got 10 minutes left, so let's just kind of buzz down the list. I can answer the first couple here. How do environmental factors like salt exposure near the coast influence the frequency and findings of the SIRS inspections? So I think we kind of mentioned the requirement is to do the SIRS every 10 years, but when you're in a salt environment, when you have older property, when you have projects going on, the best case is to do this more frequently. So 3 years is probably a good rule of thumb for an inspection. Some could go a little longer, some might need a little bit sooner, but 3 years is a good average for communities. And then the findings, so we're seeing, of course, is conditions from that extreme salt environment that are wearing out all items. We talked a lot about concrete restoration, but railings, your plumbing, your fire protection systems, fire suppression systems. I mean, when they're exposed to salt air in our extreme environment here in Florida, boy, that they just don't last as long. And it's interesting. We've seen cases where, you might have the sprinkler pipes on a 10-story building. The first couple floors actually on the beach have a lot faster deterioration than the top floors. And why is that? Well, the salt, they're closer to the salt air and the mist that comes off the ocean. So it's interesting how it can even happen on one elevation of the building versus the other. The conditions can vary greatly, but it certainly does impact the remaining useful life of items, impacts the cost and scope of work that needs to get done with them as well.
That sort of rolls into Ivan's question, the 25 years by the coast. So that was in the original law, and we had trouble, everybody had trouble defining what's the coast, right? So what they've said now is the milestone is every 30 years, but the local municipality is the one that's responsible for making sure it gets done. So they can lower it to 25 at their discretion. So for most coastal communities, expect it to be 25 and
Yep.
just think along those terms.
Yeah, I was talking with a customer that we work with a lot, but they had a milestone inspection. They fall into that case where there are only 2 habitable stories or a 3-story building, so they had to do their milestone. And it turned out they found some work, and they're working with the city county on phase 2. And it was like, well, now we don't have to do the milestone. You think the county is going to let us off the hook? And it's like, absolutely not. Once they find out there's an issue with that building, they're gonna stick to that and see that through. I would hope. And again, it's like there's what you have to do. Like you're supposed to stop at every stop sign. Does everybody stop fully at every stop sign? No, but the laws are there for a reason. If you blow through every stop sign, you're going to end up with a big issue down the road. So good point there. Paul asks a question. Can we postpone fully funding the reserves if we completed our SIRS and budget prior to December 31st, 24, postpone until 2027? So we talked about the 2 conditions that you could, or really the 2 conditions that would allow you to postpone funding the reserves with regular assessments. One would be if you're get a vote of the members and you're working to conduct your milestone work. So you've got repairs that were identified by your milestone that can be paused. And then the other one was you can use special assessments, loans, or line of credit in lieu of reserve funding as well. So those would be the 2 options. If you don't use either of those options, and with that line of credit too, one of the comments in there is that it has to be sufficient to cover all previously waived items. It has to be immediately available for the board, and it has to be reflected in your structural integrity reserve study. So you really have to have an updated study if you're going to, if that wasn't part of the initial study, in order to make that work according to the statute. So there's some hoops you got to jump through there, Paul, to do that. And again, in a lot of cases, unless the projects are all right up front, the financing piece isn't really your long-term answer there.
What else do you want to hit in here?
Yeah, we just go. I'm just going down the line. Richard's next. We had a reserve advisors perform our SIRS study. Just look at the database link and can't locate our association project. Probably means you didn't let the division know that it was there. That's not a reserve advisors. Again, we talked about that's not reserve advisors' responsibility, or any of your engineering firms are not responsible for distributing that to your owners or notifying the division that it has been distributed to your owners. That's an affidavit that it's actually now an affidavit that the board has to sign, but I think the managers or the board can submit their statement that they've done it on there. If you look at the top of the database, there's a link to the form itself, the SIRS reporting form, so you can go ahead and submit that now. One thing I'll point out, it asks for some information on this form that it looks like it's required, but it's not. You do not have to submit a copy of the SIRS, so you don't have to upload that. It has an option to upload it, but that's not a required field. And it's also not required to name the company that did it and the cost of your SIRS if you don't want to name that. It's information the state wanted, but they can't really require that, and they're not requiring you to submit a copy of your SIRS there. So really just wanted to know that you've done it, and that's the statement that they're asking to have. I would imagine this form will be updated somewhat soon with the notice of some kind of a checkbox that you've signed the affidavit as well. They may want to see your affidavit eventually, now that that's a requirement in the statute.
All right.
Want to go to Brits, or you got another one you want to answer?
Yeah, no, I can try and answer Brit. So it's usually asked if pulling an accounting program, whoops, I jumped. If pulling an accounting program, what's the best way to track to make sure you're reserving properly across the specific line items in each pool? So when we have Matt or other companies make our reserve studies, we create 2 different sets of pools, right? So that table that Matt was showing, I don't think you shared it, but there's a table that shows the remaining useful life and the funding levels. We have 2 of those, right? So we're setting up 2 separate accounting setups for each one. So 2 separate sets of reserves, and we're funding each one based on that. Brit, it really depends on your accounting system. We call it fund accounting to make sure it shows up properly and is easy for our associations to review those statements. So it's simple to do. Most accounting programs have a way to do it. Just work with your accounting team, your management team, and they can set it up for you.
Yep. And a common misconception I see is that, when you have pooled reserves, you no longer have line item reserves. So you don't have, you shouldn't have a statement or a budget that says I've got roofing reserves and painting reserves, et cetera. Like you have to choose which one you want. Now you can have some pooled and some non-pooled. You can have mixes. That gets real complicated real quick, but you can do that. But once you pool, so you get the vote and you pool everything together, don't continue to show a balance for each individual item because that's misleading.
Agreed.
The next one, does the board need an owner vote to transfer money from non-structural to structural reserve pool when first setting up the structural budget? I've heard of several different attorney opinions on this, both arguing both sides of it. I think majority of what I've heard is yes, because you're potentially using those reserves for other than their intended purpose once you move it. So that would be my again, just weighing all the different opinions I have, which I should have mentioned right at the beginning. Jason and I are not attorneys. This is not legal advice for your association. We don't want to be attorneys or play them on TV or on webinars. So thanks for the question. I think, but I do think you should get the vote unless your attorney advises you otherwise.
Yeah.
Um,
This is the trap we were just talking about, the 10 years.
Yeah.
So
Yeah. Yep.
Nancy asked, if you don't do a SIRS every 10 years, do you keep the owner contributions the same for 10 years? And I this is another great one, talk to your attorney, but the way the law is written or the way I read it, that's what it says. I don't think that's a good use of your funds, and that's why you want to keep updating it and consider it. Because otherwise you're going to have funds that just don't make sense in 10 years. It just doesn't work. So best of intentions, but good practices to do it more often. And I think the same can be said of the milestone a little bit, since we're on that tangent, right? Like
Yep.
One of the things that I always struggle with, and I know we're up against the clock, is everybody says, I'll wait till the recertification or I'll wait till the milestone. The intention of those things is to have all of the repairs done when you get there and maintain your property in good condition so that when you get to the milestone or the recertification, you're getting a clear report. So don't think of it as a worst case or a waiting until. Make it that tool that it's supposed to be. Use it along the way.